In this video, I'll introduce index funds and describe the top 5 reasons why they should be part of your investment strategy. And we're starting right now. Hey, what's up everybody, and welcome to another video from the Keystone Financial Academy. My name is Elliot, and before we get going, if you're new to this channel, I invite you to join our community and subscribe and turn on notifications so you don't miss any of the upcoming financial and investing topics. And be sure to watch until the end of this video where I'll talk about a very interesting theory that describes what could potentially happen to the world's stock markets if too many people invest in index funds. Okay, first, a quick introduction to index funds if you're not that familiar with them. An index fund is a type of mutual fund that follows a stock market index. Let's break that down a little bit more and define both a mutual fund and a stock market index. A mutual fund is just a pool of money from many investors used to purchase securities such as stocks. Each investor contributes cash and becomes a shareholder of that fund and is entitled to receive profits or losses depending on how that fund does. If you want to learn more about mutual funds, by the way, there's a link in the description below to a very recent video that I did about them. Now, a stock market index is just that. It's an index that measures the stock market, with examples being the S&P 500, the NASDAQ, the Dow 30, and a couple of others. Each index is made up of a certain number of stocks. So, as an example, for the Dow, there's 30 stocks. For the S&P 500, there's just over 500, and so on and so forth. If you want to learn a bit more about stock market indices, by the way, there's also a link in the description below to another recent video for investing fundamentals where you can learn quite a bit more about them. Finally, it needs to be mentioned that each stock takes up a certain percentage of the index by weight, which is just market capitalization, or the price of the share times the number of shares that the company has outstanding. So currently the biggest stock in the S&P 500 by weight is Apple, and it sits at 6.4% of the index, with Microsoft just behind it at 5.7% and Amazon rounding out the top 3 at 4.9%. The rest of the stocks in the index are ranked exactly the same way by market cap all the way down the list. Okay, so now we have the definition of a mutual fund, definition of an index, and we saw how the stocks were arranged in the index, so let's put it all together. An index fund, for example, one that follows the S&P 500, which is one of the more popular indexes to follow, is made up of the same exact stocks as the S&P 500 and in the same proportion, meaning the fund would buy enough Apple, Microsoft, and Amazon stocks in exactly the same proportion as the S&P 500, with all the rest of the stocks in line just like that after them. When the fund gets more money, in other words, more investors buy in, it just buys more of the same stocks. As a result of this buying strategy, you are now investing in the index and all the stocks that make up the index. And in the case of the S&P 500, because it's widely perceived to represent the entire market, you are in fact investing in the entire market. So that in essence is an index fund. So why should index funds be part of your investing strategy? Here are the top 5 reasons. Reason number 1, low cost. Index funds are super cheap to invest with, and the reason has everything to do with management. Index funds do not need to be managed because the stocks they invest in are right there in the index that they track. And all you really need is a computer to buy more stocks as the fund grows and rebalance things occasionally as some stocks get delisted from an index and other ones get added. Since there's no need to pick individual stocks, there's no need for a fund manager or a team of analysts to do the stock picking. The results speak for themselves when you check out the expense ratios of index funds and compare them to managed mutual funds. As an example, Fidelity's S&P 500 index fund has an expense ratio of just 0.015, which means if you invest $10,000, it'll only cost you $1.50 for the entire year for all management expenses. Other index funds are roughly in the same ballpark as far as costs. Now compare that to a managed fund such as Fidelity's own Magellan Fund. This really famous fund, which was once run by Peter Lynch back in the 80s, is still around and its expense ratio is 0.7. So the same $10,000 invested will now cost you $70 per year in management fees. And remember, you have to pay that regardless of the actual returns on your investment. Reason number 2, simple and easy. Index funds are easy for beginner investors to understand and easy to follow. While index funds certainly have a place in an experienced investor's portfolio, they're especially suited for beginner investors. These types of funds are very transparent. You can easily see what they're investing in, by just checking the stocks in the relevant indices. And they offer a solid, easy to comprehend introduction to the stock market without taking up too much of your time either. Best of all, you don't need to be an expert stock picker or try to figure out which managed fund investing approach that you want. You just simply invest in the market itself. Reason number 3, superior returns. If you invest in the S&P 500 index fund, it will give you the same returns as the overall stock market itself. This is a good thing because historically stock market has been up 70% of the time, returning an average of 10% annually. Can you beat the market and give investors better earnings on their money? Of course you can. That is the stated goal of just about every managed mutual fund out there. However, here's where reality sets in. In 2019, only 29% of mutual fund managers managed to beat the market, and in most cases it wasn't by much, with the other 71% doing no better than index funds and some doing worse. Considering the fees you get charged with managed mutual funds, this low-cost index approach certainly has some merit. Reason number 4, tax efficiency. Here's an advantage most investors don't always realize. Index funds are more tax efficient than managed mutual funds. The reason in one word is turnover. When you sell a stock, you incur a capital gains tax, and managed mutual funds sell stocks all the time in order to take out the poorly performing ones. And the turnover ratio in a managed mutual fund can be as high as 85 to 90%. Index funds don't have much turnover at all, only once in a while when a new company joins an index or another one gets delisted, so their turnover ratio is very, very small, close to zero. So because of that, very little capital gains tax gets incurred and passed along to the investor. Also with index funds, you don't ever have to sell your holdings and look for another fund if a rock star fund manager retires or loses his touch, because with index funds there is no manager. Reason number 5, diversification. Index funds are well diversified, meaning that you're not investing in just one industry or sector, but many of them, or all of them, thereby lessening your risk. Even though the overall markets can certainly go down, index funds still remain the closest you can get to a sleep easy, invest and forget type of investing approach. So as you can see from these 5 reasons, index funds are a really smart investment. And while they don't have to be the only thing you invest in, they definitely have a major role to play, and I would say they should be the backbone of your investing strategy. Index funds are commonly recommended by nearly all financial and investment advisors, and the idea has tremendous amount of support among really well-known investors such as Warren Buffett. Now, if you're curious as to who actually invented and popularized the index funds, it was this guy, John C. Bogle. Known as the father of the index fund, John Bogle was the founder and CEO of the Vanguard Group, the world's largest fund investment company with over $3 trillion under management. After forming Vanguard, Bogle established the very first index fund available to the retail investor and remained a big proponent of low-cost index investing for his entire career. Since forming Vanguard in 1975, his investment philosophy has always been all about simplicity, common sense, and avoiding speculation by investing for the long term. Throughout his life, Bogle remained a widely respected investor and received many investing and lifetime achievement awards, and he remains a true legend in the investing world. Alright, and this brings me to the last topic, which I promised to talk about earlier in the video, and this is a subject that Bogle himself has brought up numerous times when he just got started with index funds. And the question we want to ask is index investing good for the individual investor while being bad for the overall stock market? Turns out this is quite possible, and index investing has been described in the past as what's called a tragedy of the commons. This just means that some reap the benefits and rewards of a good or service, while others pay the cost of the price associated with it. The reason for this has to do with the very nature of index investing. Funds that track indices are called ride-along financial instruments. They do not actively research companies, set prices, or trade equities. Instead, they just replicate what already exists and contribute nothing to the liquidity of the market or the movement of the market. In a sense, they're letting other market makers do the hard work of research and pricing, and thereby add to market inefficiencies. Turns out individual investors and fund managers are very much needed for a healthy financial market. Index funds are passive and don't really contribute to this effort whatsoever. It's similar to journalism, where you can have too many aggregate sites that just copy-paste news stories and not enough actual journalists doing the hard work in the field. Then the quality of the source material and then the actual material dries up and the whole system collapses. The key to all this is the overall percentage of the stock market that actually does the index investing. If very little of it is going on, similar to 30-40 years ago when index investing was still relatively new, then there are no real concerns. However, as more and more people jump on the bandwagon, there's believed to be a tipping point where the stock market may cease to function as there are not enough market makers. Experts agree that if everyone indexed, in other words 100%, there would be chaos. What they don't agree on is where that tipping point is, where estimates vary between 50% of the market and 75% of the market. As of now, with about 25% of all investing being indexed, we're nowhere near that point. Is it possible that one day we'll get there and the SEC will close off any new cash coming into index funds in order to protect the wider stock market? It is pure speculation to guess, but it is within the realm of possibility. Turns out you can have too much of a good thing, so invest in index funds for now, because there's a good chance that investors one generation from now may not be able to. Okay, so that was a quick primer on index funds and the top 5 reasons why you should be investing in them. As always, be sure to subscribe and hit that like button, and let me know in the comments below what topics you'd like to see me discuss in more detail. Thanks for watching, and I'll see you soon.